Hello guys, this week we're gonna talk about briefly actually about financing and evaluation. So because last time we have finished talking about the optimal capital structure, right? We talk about how to understand the trade-off between having a high leverage versus the lower leverage, right? So this week we're gonna briefly talk about how do we apply it. I mean, if we have the debt, if we have a very different capital structure, how do we value a company, right? How does financing enter into valuation of a company? So basically, in the very first beginning of this semester, we have talked about how to value a project or firm, right? We need to calculate the NPV, right? Basically, we estimate the expected cash flow um, in each period of the project, in each period of the firm, right? And then we discount it by a opportunity cost of capital, right? So that kind of discount rate is the rate of return forgone by not investing by investing in the project, right? Basically, and then we have the cash flow, we have the discount rate, then we can calculate the net present value of the project, right? This is one way, which is more kind of this is the main. In some sense, this is called absolute valuation because it solely depends on the cash flows generated from the project, generated from the firm. The other way the other way to value a firm we have talked about is that in stock valuation we have talked about the comparable method, right? Or relative valuation in a sense, right? This is to look up the price of a comparable project, right? So this is the second way. For example, you can compare the PE ratio of a company with other company in the same industry. Yeah. So now you get a sense of whether the company is undervalued or overpriced relative to other firms in the same industry. Right. Finally, you can use alternative criteria, for example, internal rate of return or payback method. Right? So this is the mainly three, but we mainly focus on the first two ways. So what about comparable method, right? Comparable method we have illustrated in the stock valuation already. Suppose you want to value a private company going public, right? In this case, I mean, cash flow is very difficult to forecast, right? So in that case, you can use a comparable method. For example, the company's EBITDA is 100 million. For a similar public company, similar public company to the private firm, the PE ratio is 10, and you value the IPO company at 1,000 million, right? Now, here, what are the implicit assumptions here? Right? So basically, you can see this PE ratio is derived from a similar company, right? Why do we need a similar company here? Because the public company, this company hasn't gone public, right? So it doesn't have stock price. That's why we need to find a similar public company to establish the price and get a PE ratio. And with the PE ratio, we get a valuation of the IPO company. So the implicit assumption here is that the price equals the earnings divided by R minus G, right? This is the dividend discount model we get from topic 2, right? So sorry, from topic 3, right? So price equals earnings divided by R minus G, and P ratio equals 1 divided by R minus G, right? So basically, to do this exercise, we assume that earnings are expected to grow in perpetuity at a constant rate. Second, growth rate and discount rates are the same for both firms, right? Otherwise, we cannot use the P ratio and apply to this private firm, right? This is our assumption. You can see this assumption are quite strict actually, right? That's why in reality, in more cases, we focus on the absolute valuation, which is to focus on the cash flows generated from the firm, right? So we basically first forecast after-tax cash flows, assuming the firm is all equity financed, right? And then we assess this project's risk. because we want to value this project, we need to assess the project's risk, right? And then we estimate the opportunity cost of capital, right? And then we calculate net present value using the opportunity cost of capital as a discount rate, right? Now this is the normal way, and this is kind of the way we have emphasized in the very first beginning. But how do we include the value created by financing? So one way to kind of incorporate that kind of consideration is to adjust the discount factor, right? Because the cost of capital is affected by leverage, right? Last time we already said the cost of capital is the weighted average cost of capital, right? It's the weighted average of the cost of debt and the cost of equity. When your leverage changes, it does not only affect the rate of return for debt holder, it also affects the equity holders' return. Equity holders require return, right? So in other words, the increase in leverage actually makes the equity holders more risky, right? That's kind of the idea. That's why the first way you can do is to adjust the discount factor. Basically, we need to adjust the discount rate downwards to account for the value of interest tax shields, right? And this is the first way. The second way is we can adjust the present value, basically. So we can calculate the APV as the base case value. So this base case value is as if the company is all equity financed, right? We don't consider leverage or debt, plus the value of financing side effects, right? For example, higher leverage, right? And also, so higher leverage has two effects, right? First of all, the interest tax shields. Second, the expected cost of bankruptcy, right? These are the two side effects we need to decompose here, right? Now let's first look at how do we kind of incorporate into the cost of capital, right? Which has been done more or less last time, right? So basically, if we have leverage or if we have financing here, right? Basically, it will change this part. So if we don't have leverage or we don't have interest tax shields, then we don't have this part, right? So basically, financing and investment decision will interact here because interest is a tax deductible expense, right? Remember, if you have a high leverage, that decreases your taxable income, right? So that means you will pay lower tax, right? So that's why this WACC will be equal to 1 minus TC times RD, n times debt ratio plus the cost equity times equity ratio, right? So this after-tax cost of capital captures the value of interest tax shields, right? Because you can see it makes the required return lower actually, right? So if you calculate this WACC, this WACC will apply for the average project, right? Now let's look at this example, right? This example, the Sangria, this corporation, the market value is 1,250, right? And 500 is debt, 750 is equity, right? So based on that, we can calculate the debt ratio and equity ratio. And we assume marginal tax rate is 35%, cost of debt 6%, cost of equity is 12.4%, right? Then we can calculate the WACC. Just use the formula here. So now if we have the WACC, we can value a project. I suppose the pre-tax cash flow is 1.731 and the tax rate is 35%, right? And so that's why the after-tax cash flow will be this number times 1 minus 35%, right? So the value of interest tax shields is picked up not as higher after-tax cash flows, but in a lower discount. So here, we don't adjust financing for the cash flows, right? We adjust the WACC, right? So what is the WACC here? The WACC is 9%, right? So we already calculated here. And assume that the initial investment is 12.5 million, right? Now in that case, the NPV will be equal to 0, right, using its formula. So that implies the rate of return for the investment will be equal to WACC, right? Because the NPV is 0. Right? So the return to equity investor must be equal to the cost equity, right? 12.4%. That's the idea. And because we know then we can again use the Sangria's WACC to value a project, right? So suppose this is the project that the Sangria wants to do, right? So suppose that the tax rate is 35%, and this is the debt and equity, right? Then we can use the same formula, calculate the after-tax interest, which is RD times 1 minus TC and times D, right? D is the debt, and here the debt is 5 million, right? So in that case, we can calculate it as 0.195 million. This is the after-tax interest. And the expected equity income, it will be, this is the cash flow, right? So the cash flow has two parts, right? One part is equity, the other part is after-tax interest, right? Which we just calculated here. That's why it will be 1.125 minus 0.195. And the equity income will be 0.93. Right? So in that case, we can calculate the return to the equity holder or cost equity, which will be expected equity income divided by equity value, right? Which will be 12.4%. So now you can see we have already applied this method to calculate the value of a project, the value of a firm, using by incorporating the financing into our NPV calculation. So basically, the project's business risks are the same as those of Sangria's other assets. Therefore, the business risk remain so for the life of the project. Therefore, we can use Sangria's WACC. Right? Remember, this cost of capital determines different levels of risk. If you use a different WACC, that's kind of saying this project will have a different kind of risk. Yeah? And this project also supports the same fraction of debt to value as in the Sangria's overall capital structure. Yeah? That's why the formula works for any cash flow pattern if the firm adjusts its borrowing to maintain a constant debt ratio over time. Right? So if a firm A is about to make a takeover offer for firm B, the A's financial managers have to decide how much the combined business A plus B is worth under A's management. Right? So then if firm C is considering the sale of one of its divisions, then it has to decide what the division is worth in order to negotiate with potential buyers, right? So this is this is where we can use this method, right? Actually, in valuation, merger acquisition, or valuation of project, you will use this method quite often. So the principle we need to keep in mind is that if we discount at WACC, then the cash flows have to be projected just as you would for capital investment project, right? And also do not deduct interest, right? Calculate tax as if the company were all equity financed, right? Because the value of the tax shield is already reflected in your WACC. Right? Remember, we have this tax rate in your WACC already, right? So that's why it's already reflecting the WACC. And financial managers usually forecast to a median term horizon and add a terminal value to the cash flows in the horizon year, right? For example, you have first the initial 5 years, right? This is, for example, this is usually called the high growth period, right? Then after the 5th year, you go to a stable growth period, and then you assume a stable growth rate forever, right? For example, after 6 years, you assume that the company will maybe grow forever at the rate of like 2%, whereas the high growth stage they grow at 5%. Right? So this is the 2-stage. And now this is when we value a firm, right? The value of the equity is basically the value of the firm minus the value of debt. That's why if you want to value a company's equity, you need to subtract the value of the company's outstanding debt. Right? This is the idea. So let's say we want to value this real corporation. So this example is on the book. The Singular Corporation is planning to acquire Rio. This Rio is a private company, right? Therefore, it has no stock price to rely on. So what that means is that now, if you want to use a comparable method, then you need to find a public company, right? Now, to use a comparable method, then you have to assume that the public company's earnings is growing at the same rate of the private firm, right? Which is hard to believe. Right? That's why we typically will use a DCF model to discounted cash flow model here to like value this company. So this company has 1.5 million shares outstanding, and that with a market and book value of 36 million, right? So 36 million is the value of the debt, right? And this company Rio has the same business risk as Sangro, right? This is the assumption. So let's forecast Rio's free cash flow, right? The free cash flow here, remember we talked about this financing problem before. The free cash flow is basically calculated assuming the firm's all equity financed, right? So then after we've calculated the free cash flow, we discount the free cash flow at the after-tax WACC, given after-tax WACC, right, gives the total value of Rio, which is debt plus equity. So then in order to find the value of equity, we need to subtract the 36 million of debt, right, the value of the debt. So basically, we forecast each year's free cash flow out to a valuation horizon and predict the business value at that horizon, which is this one, right, PVH, right? So from period 1 to H, this is a high growth period. And then after this high growth period, we enter into a stable stage, which goes on forever. So we will typically assume a different growth rate from period H and on, right? So basically what we do is that this number, PVH, this is the terminal value or horizon value, right, of all the future cash flows after period H, right? You calculate this number, right, by discounting all these future cash flows after period H to period H, right? And then you discount this terminal value to the present, right? So this is how you do the valuation. And typically, I mean, this WACC in the stable growth stage will be different from this WACC here, because the growth rate is going to be different, right? And the beta, everything sometimes will be different, right? So therefore, sometimes, I mean, in many cases, actually, this WACC in the stable growth stage will be different from the WACC in the high growth stage. So the difference between free cash flow and the net income is that income is the return to shareholder. So income, you need to calculate after interest expenses, right? But free cash flow, you calculate it before interest. Remember, there's no interest expenses in your free cash flow calculation, right? So income is calculated after various non-cash expenses, including depreciation, right? So therefore, we will add depreciation when we calculate free cash flow, yeah. And capital expenditure investments in working capital do not appear as expenses, but they do reduce cash flow, right? So basically, how we do is that the free cash flow will be equal to after tax EBIT, sorry, after tax EBIT, right? So basically EBIT times 1 minus T, right? And then minus capital expenditure, we take capital expenditures out because it reduces free cash flow. And then we take changing working capital, basically, right? Or investment in working capital. So minus investment in working capital plus depreciation, right? Remember, when you add back depreciation, right? So let's look at this example, right? Calculate Rio's FCF. So what is the free cash flow here? That is the profit after tax, which is what? So 7 plus 4 minus 8 minus 9, right? 7 is profit after tax, which is profit before tax, which is EBIT minus tax, right? So after tax EBIT, basically, right? Plus depreciation, right? And then minus investment in fixed asset, this is capital expenditure, minus investment in working capital. So that's why it's 7 plus 4 minus 8 minus 9. Right? So now if you look at this table, right, the projection of sales slow down finally. And the sales growth actually becomes slower and slower over time. The reason is that the competition become greater and greater over time. Right? Also, if you look at the cost, right, the cost also increased over time because the competition goes up, right? And also because the sales goes up, the investment in fixed asset, which is capital expenditure, also goes up, right? Because if you want to sell more things, you need to produce more goods, right? If you want to produce more goods, right, what you have to do is that you're gonna buy more machine, right? Replace more machine. Right? This is kind of the idea. So this is how we do the calculation, right? We also assume that the working capital grows in proportional to sales, right? This is how we calculate this working capital, right? We also assume, right? So that's what we assume here. The working capital is a percentage of sales is fixed. Right? That's why when the sales goes up, the level of the working capital also goes up. Right? Here we also assume there's a tax rate, 35%. The WACC is 9%. The long-term growth forecast, which is the stable growth rate, is 3%, right? So in that case, WACC is 9%. Then we first calculate the present value of the cash flows in the first 6 years. Right? This is the free cash flow. Discounted by our WACC, we get 20.3. Right? Now we need to calculate this horizon value, which is all the future cash flows from period H+1 and on, discounted to period H. We use a constant growth discounted cash flow model. Now we also need to apply this long-term growth forecasting. So suppose the WACC is 9%, right? It is still the same. We suppose in this case, right? Minus this 3% long-term growth forecast, right? Again, this is the constant growth DCF model. You can check back on the on topic 3 or chapter 3. And this is the free cash flow in year H+1, right? So now you can get horizon value. But do not forget to discount this horizon value to present time. Right? So then finally, the total value of the firm will be equal to the present value of the cash flows from year 1 to 6, right? Plus the present value of the horizon value, right? Then total will be 87.9, right? And the total value of the equity will be equal to 87.9 minus 36, right? Which will be equal to 51.9 million, right? And the value per share will be equity value divided by number of shares. So this is the way. Now, this is the way to estimate a firm, right? Just directly estimate the value of the firm. Of course, you can estimate the value of the equity as well, right? So basically, we can calculate the kind of value of equity by directly discounting cash flow to equity after interest and after tax, right? At the cost of equity capital, right? So if the company's debt ratio is constant over time, then the flow to equity method should give the same answer, right? So why it's the same answer? Because if the debt ratio is the same, then this flow to equity method, which is directly discounting cash flows to equity after interest and after tax at the cost of equity, should be equal to the firm value we estimated here, right? The cash flow to firm minus the value of the debt, right? These two approaches should be the same, right? This is the alternative method we can use. Now, broadly speaking, when we talk about this debt here, right? The debt could be different kinds of debt. And the equity here, it could be also different kinds of equity, right? Therefore, we can also write down this work by incorporating this preferred stock, right? Company has preferred stock. In this case, the value of the firm will be equal to the value of the debt plus the value of the preferred stock outstanding plus the value of the common stock would be, so it will be written as this one, right? Just basically add, we have added this part, right? So now the next question is, in many cases, right, we see that actually the cost of capital changes over time, right? So for example, when a company A acquires company B, right? Now after acquiring company B, company A becomes more risky, right? In that case, the beta will change, right? Also, after company A acquires company B, the overall capital structure might change, right? For example, company B has a lot of debt. So in that case, what happens is that the overall company's capital structure will change, right? For example, the debt will increase. So in that case, we need to adjust the WACC, right? We need to adjust the WACC when debt ratios and business risks differ, right? So this case also happens when, for example, you are taking a project that is more risky than the average risk level of the company, right? Now, in that case, you cannot use the company's weighted average cost of capital because you are looking at the value of a project that is more risky than the company itself, right? So the assumption of using WACC is that we assume that the project we are trying to value here, they have the same debt to equity ratio as the company, right? So this is the assumption. Now, in our example, what if this company Sangria's perpetual crusher project, this particular project we want to value, supports only 20% debt versus 40% for Sangria overall, right? So this suggests that we can no longer use Sangria to value, right? Because Sangria has 40% debt ratio, but this perpetual crusher project has only 20% debt, right? So in that case, cost of debt and equity both change. So there we need to adjust our WACC. Right? So this is the graph that's showing right here. This is debt ratio 20%. This is debt ratio 40%. Now you can see the cost of debt might not change, right? It's constant, but the WACC decreases because you're using more debt, right? But cost of equity increases. The cost of equity increases because you are taking more debt, right? It becomes more risky. So basically, as the debt ratio increases, the cost of equity increases, right? Because of the financial risk. So but our weighted average cost of capital actually decreases, right? Because of the tax shields on debt interest payments, right? When it dominates, WACC will go down. If there were no tax, then of course WACC will be equal to opportunity cost of capital. So this is how we recalculate the WACC at the 20% debt ratio. Remember, originally it was 40%, right? So what we do is that we calculate WACC and the cost of equity at a zero debt. This is from Miller-Mogherini proposition 1, right, using this formula. Now then we estimate RD at a new debt ratio, right? So, but in our case, we assume it's same, right? Then we calculate the new cost of equity. This is the MM prop 2, right? Cost of equity equals the, this is the opportunity cost of capital, the WACC, for example, plus R minus RD times the debt to equity ratio. Here, so keep in mind here, this is the debt to equity ratio, right? This is debt ratio. Now, after the second step, we recalculate the weighted average cost of capital at the new financing weights, the new debt ratio. So let's use this company as an example, right? So first of all, we calculate Sangria's current debt ratio is 40%, right? This is current debt ratio. So based on this current ratio, we calculate the cost of capital, right? So overall cost of capital weight or WACC here. Assume the debt cost stays at 6% when the debt ratio is 20%. Right? So then we can calculate this cost of equity here. Right? So again, this is the new debt ratio. We go from 40% to 20%. Right? That's why we use this new debt to equity ratio. That's 25% to calculate this new cost of equity. Right? After we get this new cost of equity, we calculate the work using this new cost of equity and also the new debt ratio and the new equity ratio. Right? That is 9.42%. But this is the first way that to calculate the new cost of capital, right? The other approach we can use to adjust the beta and then you calculate it in the same way. Right? That's the alternative way. We can first unlever the beta and then relever the equity beta. Right? So basically, given the beta of equity at the new debt ratio, the cost of equity determined from the CAPM, and then WACC is recalculated. Right? So we first adjust the beta. So suppose beta D equals 0.135 and then beta E, so this is the equity beta, equals 1.06, right? And we assume the risk-free rate is 5%, market risk premium is 7%. So using the CAPM model, we have the cost of equity equal 12.4%, right? Remember, this is the original cost of equity, right? Now suppose the new debt ratio is 20 to 80. Yeah? Now we use this beta adjustment method, right? First, we unlever the beta, right? So beta A equals beta D, right? And beta E, right? This is the original betas. Of course, using the original debt ratio, right? Then we get 0.69. Now we need to relever the beta using the new debt ratio. First of all, we calculate the equity beta using the new debt to equity ratio, right, which will get 0.829. Then we calculate the new cost of equity, which is 0.108, right? Right, so then after we get this, right, we go for the second step, right? The cost of equity determined from the capital, right? So finally we can calculate the WACC using the new cost of equity and the original cost of debt, right? Because we assume that the cost of debt does not change, right? And then using the new financing rate, in other words, using the new debt ratio, that is 20%, right? So still we get 9.4%, right? So you can verify this. In general, we can build a relationship between unlevered beta and the levered beta in these two equations. Yeah? Suppose the tax rate is T and the cost of and the debt beta is 0. Yeah? Then we first calculate the unlevered beta will be levered beta. This is equity beta, right? Divided by 1 plus 1 minus T times the debt to equity ratio, right? This is unlevered beta under the original debt to equity ratio. Then we relever beta using the new debt to equity ratio, right? And the unlevered beta. So these are the general principle we can use when we value a company. So the assumption of adjusting the WACC is that the company must rebalance the capital structure to maintain the same market value debt ratio for the relevant future. Right? So remember, we assume that we kind of assume that the company rebalanced the kind of capital structure, rebalance the debt ratio for the relevant future. And for practical purposes, it will be sufficient to assume that there will be a gradual but steady adjustment towards a long-run target. Right, that's the idea. Now, this is the more kind of straightforward way to calculate the net present value by considering the financing. The other approach is called an adjusted present value. Right? This is first, it has two components, right? The first component is the base case NPV. The second component is the sum of present values of financing side effects. Right? This base case NPV is the project or firm's value as a separate all equity financed venture. Right? And then the financing side effects include interest tax shields, which has a positive effect on the firm value, which is essentially the tax savings, right? And also the cost of issuing security, right? And also financing packages subsidized by the supplier or government. Right? So this is the APV approach. So let's say we use the APV approach by valuing the perpetual crush of this project, right? Now the WACC calculation assumes that the debts will be 40% forever. Right? The tax shields will be discounted at a WACC, which will be 0.984. Right? We have calculated this previously. That's why the base case NPV will be minus 1.067 million. Right? Remember, when we calculate this base case NPV, we assume it's all equity financed. Right? Therefore, we use this WACC. Right? So that's why this base case NPV will not be worthwhile under all equity financing because it's negative, obviously. Right? Now, based on that, we add back the benefits of financing. All right, the project supports debt of 5 million, for example. Now we can calculate the present value of the interest tax shields. It will be this number, right? So basically, the RD is 6%. We assume there's a 35% tax rate. The annual tax shields will be tax rate times the cost of debt times the value of the debt, right? So the annual tax shields will be 0.105, right? And then the PV of the interest tax shields will be 1.087. Sorry, 1.067, right? Now the APV will be 0 as well, right? You can see this result is actually the same as we do it directly using by adjusting the WACC. Right? They are equivalent actually here. So suppose the company SemGrid plans to keep the project debt fixed at 5 million. So there's no debt rebalancing. So in that case, we no longer discount the so here we no longer discount the interest tax shields using the opportunity cost of capital. Now remember, this means there's no debt rebalancing. Right? In that case, the risk of the tax shields will be equal to the risk of the debt. Right? In that case, we'll use 6% to discount the debt, right? And that's why the present value of the interest tax shields will be 1.97. Sorry, 1.75, right? So the NPV will be higher. It will be higher because the present value of the interest tax shields are higher, which is because the debt is safer than we expected. Right? That's the idea. So there will be other financing side effects, right? For example, suppose this company issues 7.5 million of equity with cost of issue 7%. 7% out of 525,000, right? And 5 million of debt with issue cost of 2%. Right? So in our case, you can see, assume the debt is fixed once issued, so the interest tax shields are worth 1.75, right? And then basically, when we calculate this APV, adjusted the present value, we need to take the cost of issuing equity and debt out, which will be equal to 0.058. Okay, this is the APV method. Then let's look at another example. So this example, it is a project it is a company, sorry, which has 5 years, right? Tax rate 40%, asset beta 0.7, long-term government growth was 6%, market risk premium is 7.8%, discount rate 0.1146, right, based on the data here. This is you can think about that is the high growth stage. We also have a stable growth stage, right? And EBIT tax, right? This is EBIT after tax, right? Capital expenditure, depreciation, increased working capital, and net cash flow, right? So from this table, you can already see the net cash flow or free cash flow calculated as this EBIT minus capital expenditure plus depreciation minus increasing working capital, right? That's how you get free cash flow. So this is how you get it. So basically, the present value of net cash flow can be discounted using this cost of capital here, and this will produce the present value of 129. Right? So again, this is the present value of the 5 years cash flow. Right? So suppose we assume there's a terminal value of 287. Right? So you can calculate this by assuming that the cash flow in year 5 and on, it will be 7 times. So it will be 7 times. Sorry, the cash flows in year 6 and on, it will be 7 times the cash flow in year 5, right? So what is the year 5? It will be this number, right? So basically, we assume that the terminal value it will be equal to 5 times of the cash flow in year 5, right? So then the terminal value will be also discounted at 11.46%. So this terminal value is also called horizon value. That's the same thing. That's why the terminal value has a present value of 167. Then the total value of the firm will be sum of the present value of the terminal value plus the present value of the first 5 years. Right? This one. Now let's look at the value of the tax shields, right? Suppose the tax rate is 40%. And we assume that the kind of debt, the debt the company assumes is $100 of debt at 8%. Right? So this is a kind of idea. So that means the 8% is the interest rate, right? It is applied to the debt, right? So it is applied to the year-end debt in the previous year and the debt, right? It is applied to 8%, basically. So suppose there's no debt, right? Everybody you go to 30, right? So zero interest, profit before tax is 30, tax paid 12, right? Profit after tax 18, right? So this is the cash flows, right? Suppose there's a debt, right? Assume there is a 100 debt, right? 100 debt. So then the interest payment is 8, right? Profit before tax is 22, right? The tax paid is lower, right? This is the value of the interest tax shields. Then the profit after tax is also low. So here, we don't look at capital expenditure, depreciation, and increase in cash working capital because they are the same regardless of the tax consideration, right? Because the tax consideration only changes the value of the free cash flow, basically, right? So the actual value achieved through the use of leverage is 3.2, right? Because you can see this is 21.2 minus 18, right? So this is the value of the leverage. And then this number is equal to the tax saved, right, basically. And then this number can also be calculated as the tax rate, 40% multiplied by the interest paid, right, which is 40% times 8, which is 3.2. So basically, to make the calculation for multi-year project, we basically estimate an initial amount of debt and then project the pay down of debt in future years and the consequent interest payments. Right? So this is how we do the calculation in this case. Let us assume that 150 of the debt, right, initially. Initially, the company takes 150 of the debt, right? So this is the beginning debt. Right? So because you can see every year you pay off some debt. That's why the remaining debt will be smaller and smaller. Right? The interest rate, we still assume it is 8%, right? So now let's look at this table. Right? Again, the debt here initially it's 150, right, times 8%. That's why the interest in the first period is 20, is 12, right? So then every calculation here. So calculation is the same as before. I mean the calculation of the net cash flow. And the ending debt, this is the debt at the end of the year 1. Right, will be equal to the beginning debt minus the net cash flow. Right? Beginning debt is 150, right? Minus the net cash flow 23, right? It will be equal to 127. Right? Now, this is the debt that you will apply the 8% to get the interest in second year. Right? this interest is calculated by 8% times the last year's debt at the end of the last year, right? You get this 10, right? Then all the calculation you get 10101 at the end of the year 2. Right? Again, in the third year, the interest is calculated by this ending debt times the 8% interest rate, right? So then you can get all the interest payments here. Now again, you can see in this case we have a higher tax burden. Sorry, we have a higher debt burden, right? But you can see we still pay less tax, right? We pay less taxes before. And that means there's a lower tax payments coming from the tax shield benefits. Right? Again, higher debt, more tax shield benefits. Right? So then to discount the tax savings obtained through the use of leverage, the general view is to use a rate that reflects the risk of the debt, basically. Right? And provided that EBIT exceeds interest expenses, right? In that case, the interest tax shields in any period, it's earning full, right? So then the riskiness of this cash flow is the risk that EBIT will not be sufficient to cover the interest expenses, right? Which is very low, right? So if the firm is prudently leveraged, right? So there's little chance of this occurring there implied by the riskiness of the EBIT. All right. So in that case, it makes sense to use a lower discount rate than the required rate of return equity, right? Because the required rate of return equity is more risky, right? So in that case, we can actually use the cost of debt, right? Because it's safer, right? Which is the pre-tax rate of return on debt. Right? So this is the value of the interest tax shields. Now let's look at adjusted present value model again. In this model, the value of the firm is written the sum of the value without the debt of this unlevered firm, right? All equity financed, right? Plus the effect of debt on firm value, right? Unlevered firm plus tax benefits minus expected bankruptcy cost from the debt, right? So this is potentially, this part is potentially the other financing side effects, right? Tax benefits, tax shields, it's the positive benefits, right? But if you have a higher debt level, you also have a higher bankruptcy cost. This is the cost, right? It's negative cost. So the unlevered firm net value can be estimated by discounting the free cash flows to the firm at the unlevered cost of equity. Yeah? And then tax benefit we already see, right? Be equal to the tax rate times the debt. And finally, the bankruptcy cost is a function of the probability of bankruptcy and the cost of bankruptcy, right? As a percent of the firm value, basically. So now let's look. So this is the APV model, right? But in general, when we think about valuation, we need to choose between two kinds of model, right? First one is dividend discount model. We use this dividend discount model for firms which pay dividends and which are close to the free cash flow to equity. Right? This is similar to that kind of approach. We also use this dividend discount model for firms with FCFE, which is free cash flow to equity, a difficult to estimate. Right? For example, banks and the financial services company, the free cash flow is very difficult to estimate, right? Because they lend out a lot to borrowers, right? So therefore, the free cash flow is difficult to estimate. So in this case, we use dividend discount model. So in other cases, we use free cash flow to equity model. Where if you want to value equity, of course, right? You can also have the free cash flow to firm model, which is FCFF model. So if we want to use the free cash flow to equity model, we use it for firms which pay dividends that are significantly higher or lower than the free cash flow to equity. Yeah, so basically, if dividends are less than 80% of free cash flow, or dividends are greater than 100% of each year, right, then we can use the free cash flow to equity model, right? And also we can use it for firms where dividends are not available, right? So private firms or IPO firms, right? And also firms that do not regularly pay dividends, right? We can all use free cash flow to discount. So if the firm is a large growing at a rate close to or less than growth rate of economy, or the firm is constrained or regulated firm, right, for simply speaking. Or if a firm has the characteristics of a stable firm, right? Basically, we will use a stable growth model. Right? And we can use a stable growth model, and also because when the firm is large, growing a moderate rate. Right? So that will be the overall growth rate in the macro economy, right? Plus 10%. Right? And we'll also use the single growth model when the firm has a single product barriers to entry with a finite life. Right? So in that case, we'll use a two-stage growth model, right? If a company has a two-stage growth, right? Initially, it is high growth, and then in the second stage, it's low growth, it's stable growth. So in that case, we'll use a two-stage growth model. So let's look at this example, right? ABN AMRO. This is a bank, therefore the free cash flow is hard to estimate. So the expected growth rate based upon the current rates on equity retention ratio, which is the retention ratio is 51, right? The growth rate is 8.2%, right? So then this is higher than what would be a stable growth rate. Stable growth rate is 4%. Right? Now you can see this is two-stage, right? Initially, high growth phase is 5 years. Stable growth phase is forever after 5 years, right? Now this growth rate, remember in the second topic, or in the topic 3, when we calculate the value of the stock, we have to talk about this, right? The growth rate of dividend can be calculated as the retention ratio, or like the plowback ratio, right? It's the same thing. Plowback ratio times the return on equity, right? This is how you get an expected growth rate, right? Now you can use these parameters here to calculate the cost of equity, and the beta is given here, right? So you can use this to calculate the expected EPS in year 6, right? To calculate the EPS, the DPS dividend per share, and the PV of the dividend per share. Right? And also we can use it to calculate the terminal price, which is terminal value basically, right? And the present value of the terminal price, which is the present value of the terminal value, will be this one here. Right? And then the value per share will be 27.62, right? Which will be equal to the value of the first 5 years plus the value of the terminal price. Right? So, but the stock, so essentially, the actual price of the stock was trading lower than this predicted value. So we can also decompose the value into the value of the stable growth and the value of the high growth, right? You can look at this on your own. It's just decomposing it. So the rationale for using this model is simple, right? The consensus estimate of growth in earnings is roughly 8%. Therefore, this is a reasonable estimate. So in many cases, for many firms, it will be reasonable to estimate free cash flow, but for financial institutions, it will be difficult, right? So therefore, we use dividend discount model, right? So this is kind of idea, right? So this is so much for this week's topic, which is talking about the financing and valuation.